Very good morning to everyone. Very good morning. Is anyone there? Can anyone let me know, is the audio video clear to you all? Anyone please, is the audio clear? So that I can proceed further. Alright, so I'm assuming that everything is okay, so I'm proceeding with it. I welcome you all in the series of editorial analysis related to finance and economy of the major newspapers. So today, among all those newspapers like ET, Business Line, Business Standard, Indian Express, Hindu, there was no economy or finance related article as such. There was only just one column which I found in the Hindu regarding RBI's guidelines on gold loans of NBFCs. So we'll be doing that only in today's session because there was nothing else related to economy or finance in all these newspapers today. Okay. Alright, so as you can see here, the heading is RBI's eye on gold loans, right? So basically this editorial of the Hindu talks about why is RBI keeping an eye on the gold loans. This is your news. So we'll analyze that what is the concern, why RBI is becoming more stringent in implementing the gold loans, or what are the issues, right? And what are the norms to be followed by banks or NBFCs in case of gold loans, and what could be the harms if these norms are not implemented. Alright, so we'll be discussing it. Can anyone let me know, is it going live or not? Alright, so the chat was not visible to me, so I thought it is not going live. Sorry for the pause. So let's start again. Okay, let's start again. So here is your article on RBI's eye on gold loan. This is your screenshot. So it talks what prompted the central bank to increase its scrutiny of the gold loan business of NBFCs. What were the reasons? Let's discuss about it. So basically, RBI is trying to be more strict in implementing the gold loans for the NBFCs. So here is the heading: NBFCs, their gold loans and the RBI. So we'll be trying to understand this triangle. Okay, what is in the news is that RBI is increasing scrutiny of gold loan business of the NBFCs after some of the NBFCs are found flouting the gold loan or gold loan norms. So basically, some NBFCs have been found doing irregularities or not following the gold loan norms which have been provided by the RBI. So that's why the RBI is keeping an eye on them, and one of them has been banned as well, which is IIFL Finance. IIFL Finance. So first of all, what is an NBFC? You all must be knowing by now that what is NBFC, right? Non-banking financial companies. NBFC means non-banking financial companies. NBFCs are non-banking financial companies. Okay, you know what is an NBFC? Yes or no? We have discussed, I think, this the difference between a bank and NBFC in one of the editorial analysis only. So non-banking financial companies are basically those financial institutes which act as a bank, but they are not a commercial bank, or they do not have a bank license as such by RBI, right? So what is the difference? There are a lot of differences, but the major ones to be remembered are that NBFCs or a non-banking financial company cannot accept the demand deposits. Okay, NBFCs cannot accept the demand deposits, it only accepts the term deposits. Now what is the difference between a term deposit and a demand deposit? So basically, demand deposits are all those those deposits which you can withdraw on demand. So there is no fixed time limit before which you cannot withdraw, or there is no lock-in period as such in that case, right? While for example, your savings accounts, you can withdraw money at any time, but on the other hand, you have something called as fixed account or fixed deposit, right? That has a lock-in period that you can withdraw only after that. Okay, so FDs and all are term deposits which are having a particular timeline. After that, you can withdraw your money, right? So these are the differences between demand deposits and term deposits. So NBFCs only accept such deposits which are there at least, which have a time duration or lock-in period of at least 12 months. Okay, at least 12 months or 1 year basically. So that is what makes NBFC different from a bank. There are a lot of NBFCs belonging to each different sector. For example, in infrastructure you have NBFCs, for say microfinance you have NBFCs, right? So these are the non-banking financial companies. They are non-banking, but they are financial companies. So now the news is that NBFCs are indulging in some kind of irregular activities, or they are not following the gold loan norms. That is why RBI has become more serious about it and is trying to scrutinize these gold loan norms regarding NBFCs. For example, the NBFC which is in news is IIFL Finance. IIFL Finance. So it has been banned by RBI now because it was issuing further gold loans, or say it has been banned from issuing further gold loan because it was indulging in some activities which were not according to the norms specified by the RBI. Now the question here is, now what is a gold loan? Do you know what is gold loan? We can only proceed further when we know what is a gold loan, right? As you can see this diagram here, you have gold and you have money. What is a gold loan? Any idea? Anyone? So basically gold loan is the loan for which you put gold as your collateral, right? So don't get confused that it is a loan which you take from a bank to buy gold. No. Okay? Yes, loan against gold. So gold loan is basically such loans which have collateral as gold. Collateral means something which you keep as security against your loan, so that if in case you default on that loan, the bank can auction or sell that security to recover the losses. Are you getting my point? So gold loan is basically where the borrower keeps gold as the collateral. Keeps gold as the collateral. Is that clear? Now let's move ahead. What are these norms which we are talking about? These are very interesting. You might not have heard about them as of now, but it would be interesting to know about these things, right? So what are these norms on gold loans? Let's see. RBI has certain norms to be complied with in regard to gold loans only we are talking about, although there are regulations for each type of loan and lending activities, right? So first is that lenders are not allowed to lend any amount of money which is more than 75% of the value of gold. So remember, this is important. First rule which says that any of the lender, be it a NBFC or any financial institute, it cannot lend more than 75% of the value of the gold, because it is a gold loan. So you put your gold as security or collateral. So gold here is your collateral, right? Collateral. So whatever the value of your gold is, which you have put or deposited as collateral with the institute, financial institute or NBFC, the amount which can be granted as a loan against that should be less than 75% or around 75%. So that amount credited or given as credit cannot be more than 75% of the value of your gold as the collateral. This is one of the norms, but it is being violated by NBFCs. They are indulging in aggressive lending. Okay, so we'll see all the issues. So first norm is clear. No amount more than 75% of the value of the gold. Why is this rule there? Because at least you should keep 25% of the value as safe, isn't it? Because in case the borrower defaults, how would you recover your loan? And you know that NPA is a big problem in India. We have been struggling to reduce the NPAs of the entire banking system, and in particular the public sector banks. Okay, that's why. So that the bank can recover loan amount in case of any default which happens, right? Second rule which we need to talk about, or which has been talked about in that editorial, is in compliance with the income tax rules. RBI also has a provision which also complies with the income tax rules. You all know that income tax department wants every transaction to be transparent so that they can tax the whichever the income bracket you are in, right? So according to that rules, RBI has a norm that no more than 20,000 rupees, no more than 20,000 rupees can be disbursed in the form of cash. So if you are disbursing this loan, gold loan, in form of cash, for example, or you are disbursing this loan, so in cash you can disburse only up to 20,000 rupees. Now if the loan amount is more than 20,000 rupees, that needs to be credited directly into the receiver's or buyer's bank account. It has to be online. It has to be given directly or sent directly to the bank account of the buyers. Okay, so only 20,000 cash can be given. Are you getting my point? So this is another norm which we have. Next, it also instructs that the lenders should conduct auction of any gold in case there is a default in a fair and transparent manner. One more thing, that even apart from these norms, even if there is a default in case of a gold loan, you can auction that gold, okay, which has been kept as collateral. But that should be done in a very fair and transparent manner, also in such locations which are easy to approach for the buyers. Is that okay? So, are these norms clear to you all? First is, no more than 75% of value of gold can be given as loan. Second, no more than 20,000 can be given as cash, and remaining amount should be credited into the bank account. Okay, and then if there is a default, you can auction that gold in a fair and transparent manner. But the question here is, the story doesn't end here, that okay, these are the norms which we have already been established. Why are we talking about them right now? Or why RBI is trying to reinforce them on the NBFCs? So what are the glitches and the problems which have highlighted these norms again in the news, right? So why RBI is reinforcing these rules? First reason, many NBFCs are violating these norms on gold loans. You know, NBFCs have been in news for violating such norms. This is not first time, right? And if you remember, or you can relate to, can anyone relate to, and what was the status of NBFCs after GST implementation, particularly after demonetization? Can anyone relate to it? Why NBFCs were in bad conditions and why there was so much NPA? Because, you know, there is something called real estate market, the property dealers which you have. So NBFCs deal a lot with the property dealers or with the real estate market, right? And in real estate market, it is not it is very obvious actually that the income or the source of income is not so transparent, right? So what happens is, when GST got implemented, so now you have everything registered, okay, every transaction registered. If you are a company, if you are an NBFCs, you have GST invoices, you have to file the GST return and all. After demonetization, black money got wiped out. Some denominations of the Indian currency got banned, right? Not acceptable anymore. So that affected the real estate market, because you all know, yes or no, do you agree? You all know that sources of income in the real estate market are not always legal. Yes or no? So that's how at that time there was a downfall in the real estate market, as you can see, and many of you can relate. You must have seen in your families as well that since that demonetization which has happened, the prices of land which you are owing, suppose your father owns a land, so he might not be able to sell it. So you must have been continuously hearing that the prices are not going up. So it is still down. The real estate market has not picked up yet, right? Because of those reasons, and that's why NBFCs also got NPAs. NBFCs also got lot of NPAs. NPAs are nothing but they are the bad loans. So their loans got defaulted because many of the buyers from NBFCs are the real estate players, the property dealers, brokers. Okay. So this is how it affects the economy very substantially, right? So many NBFCs are violating these gold loans as well, or norms as well. For example, the NBFC which has been banned to extend further gold loans is the IIFL Finance. IIFL Finance has been caught with so many irregularities. What kind of irregularities? Irregularities in almost everything. The size or the amount of loan which you are disbursing, the terms of loan, the risk associated with loan, the valuation of the loan, etc., etc. So you need to have a risk weighted ratio, right? You need to assess the risk of the loan before granting the loan, right? So when you do not perform all these rituals properly, all these things properly before extending a loan, it can amount to defaults. In many of the defaults, there has been cases of IIFL Finance and many more NBFCs in which they were not able to gauge the risk associated with that loan properly, or it might happen that they did it deliberately. You never know, right? The case can be in that way as well. So particularly these irregularities were found, and particularly when we talk about something called as loan to value irregularities, loan to value ratio, loan to value ratio. This have been found in almost over 2/3 of the defaulted accounts. So IIFL Finance has a lot of defaults or NPA. NPA is what? Non-performing assets or the bad loans, the loans which do not come back, right? Over 2/3 of these loans have been evident with this problem, which is loan to value irregularity. Now, what is loan to value ratio and what is this irregularity? I'll explain. Okay. So, is this clear to you all? If I remember correctly, I have even checking the gold quality properly. Yes, right. So, not checking the loan to value ratio and not checking the risks, not checking the gold value, rather they were exaggerating or over calculating the value so that they can extend more than 75% of the loan. Are you getting my point? So, these kind of behaviors have been noticed. Now, let's understand this important term. This might be useful for you in any of the examination. Loan to value ratio. What is loan to value ratio? Okay. First, let's understand this. Then I'll come back to this slide. What is loan to value ratio? So basically, this is a formula or a concept used to assess the lending risks involved in the loan to be disbursed. So basically, it assesses, it measures how much risk is involved in the loan which you are planning to disburse to the buyer. Okay. Now, what is the formula for this? Formula is mortgage amount. So you have the mortgage amount divided by the appraised property value. Okay, and it is often expressed in percentage. So we multiply it by 100. Mortgage amount divided by appraised property value into 100. Okay, so this is the formula of loan to value ratio. It is nothing but the method of assessing the risk involved in extending that loan to a buyer. Now, what is a mortgage amount or mortgage value? Basically, the loan which you want to borrow. Are you getting my point? The amount which you want to borrow divided by appraised property value. Now, why isn't it the actual value? Why is appraised written over here? Because it has a reason attached to it, that while assessing the risk involved in any loan, the lenders try to assess the future value or the assumed value, appraised value. It is not the actual value. They try to assess, okay, what might be the value of this gold. Are you getting my point? So that's why the assessed property value, either you can have gold in case of gold loan, you can have a house as a collateral in case of property. So what is the assessed? The expected value of that property is appraised property value. So when you divide them and multiply by 100, it gives you the percentage of risk involved in lending that loan to the person. Are you getting this point? Everyone clear about this formula? So, and one more thing which you need to note here is, higher the loan to value ratio, higher this ratio, higher is the risk involved. Okay. So, greater is the value of this ratio or percentage, greater is the risk involved with the loan. And remember one thing always, that when the risk involved in the loan is higher, the interest rate will be higher. And when the risk is lower, the interest rate charged will be lower. This is very commonsensical, right? Because if risk involved is higher, the banker or the lender will try to recover or reduce that risk by increasing the interest rate. Okay, so even if the person defaults, they'll be able to recover much of the amount by way of higher interests. Are you able to understand this? So whenever the LTV ratio or say loan to value ratio is higher, that means there is a higher risk involved, and when there is a higher risk involved or there is a higher risk of default, higher would be the interest rate charged. Higher would be the interest rate charged. Right? So this is the concept of loan to value ratio. Very interesting concept. Now let's go back to that slide. Okay. Why is RBI reinforcing this? So we have seen that IIFL and other NBFCs have been indulging in irregularities, and particularly loan to value irregularities have been found in over 2/3 of the defaults. It means over 2/3 of the loans which have been defaulted may be accredited to loan to value irregularity in some way or the other. Are you getting my point? Also, NBFCs are trying to overestimate the value of gold, as I have discussed it with you earlier, that some of the NBFCs are trying to overestimate the value of gold so that they can lend beyond that limit which has been provided by the RBI, which is how much percentage? 75% of the value of the gold, okay, or the collateral, right? So they are trying to overestimate the value of gold. It might happen that it is helping them in short run, but it will not help them in the long run. It will only lead to defaults in the long run, right? And once there is a default, they will be running to RBI and other regulators for help, right? So the IIFL and others are also using internal assayers of loans. Yes. Another irregularity which has been found is that the assayers, who are the assayers? So when you are assessing basically the risk, okay, how much risk is involved, or basically in case of gold loan, what is the value of gold? What is the value which you are trying to take as the loan? How much risk is involved? What is the value of your gold? How pure it is, right? So all these assessments are done. So it has been found that IIFL for the time being and other NBFCs as well are indulging in using internal assayers. Now, what is the problem with this? On the other hand, the commercial banks are using external assayers. So this is not the problem with them. Why is this difference? Or how internal assayers can be a problem or can be a threat? Or how is it exaggerating this issue? Anyone, any idea? See, if your assayers are internal, that means they might be part of your management as well. So the transparency can lack on this behalf. Yes or no? Isn't it? So here you can have transparency issues because it is internal, not external. The banks on the other hand are using external assayers to manipulate. Yes. So when you have someone from your inside or from your organization only, it is easy to manipulate the data and the facts, or to violate or surpass the laws, right? So these are certain problems which are there, and therefore RBI is trying to reinforce these gold loans. That is why this is in news and it becomes important for you. All right, clear with this? Moving ahead. So we have done the loan to value ratio. Now the question is that these are the irregularities which have been found. So RBI has banned IIFL and being strict on the other NBFCs in terms of providing gold loans. Why is this an issue for us? Okay, so actual analysis starts from here. Why are we concerned about it? Why we do not want the NBFCs to do certain irregularities like this or to indulge in those kind of aggressive lending practices? So there is something called aggressive lending or predatory lending. Are you aware of this term? So it is your first class, okay? Very good. It would be I would be happy if it helps even 1% of the students, right? So the aim is only your selection, your satisfaction, right? So stay tuned. Now let me know that why is this a concern? Why are we concerned about this issue? Okay, we are concerned because we have faced this problem which is there, known as twin balance sheet problem, for a long time in India. So almost if we trace the history of something called twin balance sheet problem, it is since 2000s in India. or after 2007 and 8 it increased. Why? Because before 2007-8, in 2008 we had a financial crisis globally, you all must be knowing, right? Yes. Sort of what caused the financial crisis? Yes, but not the main reason of that. Okay, it can further this problem, which is twin balance sheet problem. So in India, we have had these kind of problems. Now, what is a balance sheet and how such activities or aggressive lending? Yes, I was to discuss about aggressive lending as well. There is something called aggressive lending or predatory lending. What is it? When banks or any institute which is involved in the lending activities are trying to increase their lending beyond the norms and all by manipulating the customers, by increasing the rates or charging say hidden fees, extra fees, all those kind of activities. Just what they want is to increase their amount of loans, right? This is known as predatory lending or aggressive lending, which often involves manipulating the customers. It often involves hidden fees and charges, right? So yes, lend for lending's sakes or lending's sake, right? Now, what is twin balance sheet problem? Let's understand this and how such activities, such aggressive lending and predatory lending activities can affect Indian economy and lead to such problems in the economy. What is a balance sheet? You must be knowing what is a balance sheet, right? So, balance sheet is nothing but a statement of an institute or company which shows you the status of assets and liabilities broadly. Other things are also there, but broadly you have something called assets and liabilities. So, this is how your assets and liabilities, right? Simplest presentation of a balance sheet, assets versus liabilities. Yes, right? So, balance sheet is what? It is a financial statement that summarizes a company or institution's assets, liabilities, shareholders' equity at a specific point of time. That, okay, at this point of time, the status of your asset and liability is this. Are you getting this point? So, this is your statement and this is your balance sheet, assets and liabilities. Clear? Apart from the other things, it is mainly a statement of your asset and liabilities, right? So, this is your balance sheet. But what is this twin balance sheet problem? Before understanding the twin balance sheet problem, I would want you to get very clear about the difference between an asset and liability in case of a bank or a financial institute which is working as a lender. Are you getting my point? So, if I ask you that NBFC lending, right? So, it is working as a lender. So, when I say bank or NBFCs, from the point of view of someone or as an institute who is lending the amount, what is the asset and what is the liability? So, when I say loan and when I say deposits, tell me, loan is asset or liability for the lender, which can be a bank or can be an NBFC, Tell me, loans are assets or liabilities for the lender? Asset. Very good, right? So, when I say asset, that means we are talking about loans which are given by the institutes. Why is an asset? Why it is an asset for the institute? Because it is earning for them, it is giving them earnings, right? That loan has something called interest rate. So, the buyer who has took the loan will return the principal amount as well as the interest rate. So, this is the amount of money through which the lender is earning. So, it is an asset, right? On the other hand, deposit is a liability for that institute. Liability for a bank or for NBFC. Why deposit is a liability? Because you have to give it back and you have to give interest on that particular amount which has been deposited by the customer. Yes, money making instrument. And why deposits are liability? You have someone's deposit with yourself, right? So, that deposit is to be given back and you have to pay back the interest, not the customer. So, this is what the difference is. Got this? Yes. Okay. Now, let's talk about the twin balance sheet problem. Okay. So, what happens is, twin balance sheet problem happens when there is a problem in the balance sheet of the bank. When I say bank, I also mean NBFC. Okay. So, I will not repeat it every time. So, I will say bank only. You have to understand that when I say bank, I mean all the lending institutes involved in this process. So, it basically involves the corrupt balance sheet, or the balance sheet which is not which has been corrupted or which has imbalances for the companies as well as for the bank. So twin means two. So here two stakeholders are involved, right? Twin balance sheet problem. So this problem lies with two balance sheets, one with the balance sheet of the company and two with the balance sheet of the bank. How is this problem arising? Let's see. First, we have companies, over leveraged companies, those companies which are not able to earn properly, so they are unable to pay back their loans, right? Debt accumulation on companies. So debt is accumulating on those companies. They are unable to reduce that debt or pay back the debt which is outstanding on them, right? Is very high, and thus they are unable to pay interest payments on loans. So they are unable to pay back the interest which is their liability, right? So this is first problem. Now this problem also creates problem of the in the balance sheet of the bank. So you have bad loans in the banks, non-performing assets of the bank increases, and it creates further liabilities for them. Let me explain to you. So suppose you have a company X, okay, and you have certain bank here, say Y, okay. You have balance sheet of this company where you have assets and liabilities, and you have balance sheet of this bank where you have assets and liabilities, okay. Now for company, what are the assets? It might be anything, capital or anything which is letting the company earn. What is the liability for the company? Okay, yes, all right. So first let me explain this, then I'll come back to your questions, right? So you have assets and liabilities. Now what is the liability for the company? Suppose this bank has provided loan to this company, okay. This bank Y has provided loan to this company X, okay. So this loan is liability for the company X. The company has to pay back and pay interest on this, but the company is overburdened with loan. The debt has been accumulating on this company. It is unable to pay back the interest rate even, or the interest which has been charged on this loan. So if this loan is not paid back, or the interest here is not paid to the bank Y, how will it affect the balance sheet of bank Y? The loan is registered as an asset in the balance sheet of the bank, isn't it? So it will reduce the assets of the bank, yes or no? Are you getting this point? Let me know. Right? So it will affect the assets. Now it has reduced the assets of the bank, and if asset gets reduces, the balance sheet of the bank gets corrupted, right? Now bank is not able to earn on the loan amount. From which amount did the bank extend credit to this company? The amount which has been deposited with the bank from the borrowers. It can be of anyone, it can be the amount of any of the borrowers or say depositors, okay, any of the depositors of the bank. Now it's bank's liability. The deposits are bank's liability. The bank has to pay interest on the deposits of the depositors and to pay back the principal amount as well. So if it is not earning on the loan extended by it to the company, how will it be able to pay back the deposits or to the depositors? So the balance sheet here also gets corrupted, isn't it? So that is how there is a twin balance sheet problem. Default on one side leads to chances of default on the other. So one balance sheet gets corrupted, it corrupts the other balance sheet as well. This is what we call as twin balance sheet problem. So balance sheet of the company and balance sheet of the bank both get defaulted, okay. Are you getting this point? Right? So there was a question by Ajit Saroya. NPA किस अकाउंट में रखता है बैंक? Okay. So basically NPA is what? Bad loan. But loan is an asset. Until you are in the process of classifying that NPA, you have identified that okay, it is about to default. So there is something called special mention account. Ajit, there is something called SMA. Okay, special mention account. SMA, special mention account. So when the bank identifies that it is going to default, or there are chances when you delay the interest payment by a few days, then you are classifying it in special mention account. Okay, if it gets defaulted, then you classify it in the defaulted account, or say defaulted category, not account as such. So this is how banks classify them. Is that clear? Is your question answered? How it affects the balance sheet of the company? See, company affects the balance sheet of the bank. Bank has certain depositors. This might be the case that company only has deposited certain amount with the bank. So bank will not be able to, if NPA gets bigger, bank will not be able to repay that amount. Okay. How it affects the balance sheet of company? Okay. What causes this double balance sheet effect, ma'am? The bank's lending, bad loan, business not being able to generate income. This can have many of the reasons. We cannot count the reasons, right? The company might not be working due to, say, recessionary conditions. The company might not be working because the company is not economically viable, or it does not have proper assets, or it is running into losses, for example, right? Or it has defaulted on something, or some client has not given the payment back. Any reason can be there why the company is defaulting. Are you getting my point? But the point is that it is defaulting. So when it defaults, it corrupts the balance sheet of the related bank as well. Okay, and the NPAs have several classification. NPA is a proper chapter which you have to read. It is a proper subject to not subject but chapter. Okay, so you have SMAs, a special mention account, then you have defaulted and doubtful assets. So when the bank has known that okay, that this might get defaulted, so they put it according to how many days of default is there. They try to put them in certain categories or classify them in categories. It is asset only, but then you classify them according to the number of days which have been delayed, right? So special mention account, doubtful asset, lost asset. If there is a default of say almost 1 year, it would be lost asset, but it would be asset anyway. All right, make sense? All your questions have been answered. Any more questions related to this? All right, so let me move ahead now. So this is how your twin balance sheet works, and this is not something which is new to India. What happened is, before 2007-8, you know that Indian GDP was increasing, and at a point of time we had something a figure of 11% GDP as well. But after the 2008 financial crisis, India also got affected to a certain extent. So twin balance sheet problem could have been seen from that period only. And in 2017, 18, 19, as you know, the NPA problem was highlighted, NPA increased. They have been identified. Now RBI and the government as well is working extensively to reduce the NPAs, because it leads to certain problems like this. Okay, so for our on the front of RBI, you have lot of schemes which were earlier there, like S4A scheme, 525 ratio, right? The SARFAESI Act. Okay, but now everything has been subsumed under IBC code of 2016, the Insolvency and Bankruptcy Code. So now you have IBC, Insolvency and Bankruptcy Code, on the part of RBI, which is trying to recover and recorrect all these problems of NPAs. It is a huge topic to be, will not be able to discuss it right now. Okay. Yes, ARCs, one of the important initiatives which have been established. The asset reconstruction companies have been helping in recovering these loans. Okay. Now, so this was your twin balance sheet problem. how do you relate this with the default in gold loans being identified by the RBI? So if say IIFL continues this practice, it might get a lot of NPA. Those NPA might be corrupting the balance sheet of some banks. And if your bank is not sound enough, when I say bank is not sound enough, that means bank's balance sheet is getting corrupted. The bank does not have enough assets or liquidity that can pose a threat to the economy. Always remember, if your bank has enough liquidity, you can stand any of the financial crisis. Okay, and this problem and this advantage of having a strong banking system has been highlighted by last year's Nobel laureates as well, if I am correct. Okay, so as far as you have a lot of savings in the banking system, you may be able actually to come out of any financial crisis. Okay, but if your banking system is not strong, any of the financial crisis in either of the part of the world will affect you or your economy substantially, because now everyone is interlinked. We have been globalized, so crisis in one part of the world affects the other as well. So if you need to stand by all such kind of financial crisis, you need to have a strong banking system. That's why RBI keeps on checking these kind of irregularities. Okay, so this was your twin balance sheet problem. Here you can see the balance sheet reducing or getting corrupted of the company and of the banks, right? So RBI wants NBFCs not to indulge in such kind of lending activities and avoid any chances of NPA and other systematic risks involved. Therefore, it is strictly scrutinizing the implementation of these loans by the NBFCs. Okay, so this was all about today's editorial analysis. There was no other economy or finance related article which was important for you, although there was something called inheritance loan which is proposed, just said by the Prime Minister, to be imposed on the buffaloes in India, but the article was more of a political kind of in nature, right? So I didn't pick it up, and this was only relatable and useful for you. I thought it would be helpful for you to understand how these things works, and twin balance sheet problem is something which would be a gain from today's class for you, right? So we'll be doing these kind of analysis on daily basis. Let's stay tuned and try to capitalize upon this initiative, right? I hope it helped you a lot. Thank you so much. I'll see you in the next session. Till then, all the best. Have a good day. Thank you.